Welcome, I'm David Adams and this is my Q3 2013 Market and Wealth Management Update. For those of you that tune in regularly, I'm working on something called brevity this time, which isn't really my strong suit, and really in hopes of getting these videos to around 3 minutes where they're more palatable for each of you viewing these. So here we go, I'll do my best. A little bit of housekeeping. I'm so excited to have my new team in place, and many of you have had a chance to meet them or at least read the email announcements. But I feel that we have a world-class wealth management team. Nikki Boston is our new Director of Client Experience. Kelly Martin is our new Client Service Associate, who's helping Siobhan Farler, who most of you know, who's our Director of Client Operations. We've also added George Landolt as our business coach and mentor, who's really making sure that our team is firing on all cylinders. George has over 30 years of experience in this business and is committed to making sure that we're functioning at full efficiency and effectiveness for you, our client base. He's met with and consulted with some of the wealthiest families here in the Southeast and really understands their fears and goals and emotions, and has also seen where many other wealth management teams have fallen short to meet these goals. So his passion and experience matched with my team's passion and experience to be the best and also to be the best at what we do, I think it creates a dynamic that I'm very excited to share with each of you. All right, so let's shift gears a little bit to the market. This last quarter has been interesting, to say the least, as the U.S. stocks have actually led the charge, while international and emerging markets have really been struggling, and the same goes for bonds. Most bond managers are actually negative for the year, with the Barclays Aggregate Index actually down a little over 3%, and that was after the 10-year Treasury went from around 1.5% to about 2.7%, all in early July. So hopefully most of the damage is done here in the short term and things are beginning to settle. But the key is to really make sure that your portfolios are utilizing managers that are interest rate sensitive. So if you watched my past 2 quarters videos, which I hope that you did, you'll remember me going on and on about this. And we've been making this transition in our bond portfolios for about a year now. And we may be a little bit early, but I think this trend of rates rising is really going to continue over the next 1 to 2 years. But remember, this is generally good for equity returns. So as long as you have the appropriate exposure to fixed income and maintain and even consider increasing your equity exposure just a little bit, this can really signal growth opportunities for your portfolio. Keep in mind also that many of the institutions and endowments are actually raising their equity and alternative exposure in their portfolios, primarily at the expense of the fixed income. And this is simply because there just isn't sufficient demand for bonds right now, given where interest rates are. All right, so these international managers, they're having a tough time lately, especially with emerging markets being down double digits. So this has made a balanced, diversified portfolio look fairly unattractive, especially when you compare it to the S&P 500, which is up double digits. I definitely think you need to own active managers versus passive investments in these areas, international that is, because of all the volatility and therefore opportunity. Basically, these managers have more of an ability to add alpha, which is excess returns, in this international space. Okay, while it always sounds like an excuse when a financial planner is trying to justify why his or her returns aren't where they should be, it's very important that my clients understand, don't take this the wrong way, that we don't care about 1-year returns. We care about compounded returns over a 5 to 10 year period and risk management. Don't forget 2008, where this same S&P 500 that's up double digits lost almost 40% and then was down about 50% during the bear market. That meant that a portfolio that was tracking this index would have had to return 100% just to break even, whereas many of the balanced portfolios I'm talking about, like a 60% equity, 40% bond blend, were down significantly less. So the moral of this story is don't focus on short-term returns. Think about your goals, and which should be compounded returns and more money in your pocket when you need it. There will always be a better manager or mutual fund or someone that's running a better portfolio, but is your plan sound and is it being monitored? So it's very possible that your portfolio being up single digits with the S&P up double digits is actually a good thing this year, especially if you have a balanced allocation of stocks, bonds, and alternatives. Okay, so let's talk on a macro level. All of the big areas that I talk about quarterly in these videos are still improving. That's housing, autos, jobs, and consumer debt. Housing I worry about only because a rise in interest rates could have a lot of impact on this recovering market, but I still think that we have some time. However, economic indicators have been better than expected in housing and employment, so that's good. The stock market has been surprisingly resilient in the face of these rising interest rates. Even a small raise in these rates has been showing people how much risk they actually have in their fixed income portfolios. And this has really caused a lot of people to revisit their plans with their advisors. The major current risk that we see right now in the economy is a continued slowdown in China, also the Middle East and Egypt with higher oil prices, and the effects of higher rates on housing, like I just mentioned, and what the cost of borrowing on individuals and corporations could entail. The major tailwinds for this economy are likely job growth, the private sector expansion, and renewed participation in the stock market by individuals. That is, there's still plenty of cash on the sidelines, and the stock market continues to look better and better, especially as bonds struggle, CDs are still near zero. In general, corporate earnings are also decent, and the economy is growing, albeit slowly growing. So I also talked about last quarter about how I felt like there was a backstop for this falling market, meaning that all of this cash seems to be propping this market up anytime we have a pullback. Many clients have been concerned about a 10 to 15% correction, yet last quarter I tended to agree more with JP Morgan, where they said that a 5% correction was more likely because of the influx of cash waiting to come in the market. And that did prove to be the case. Let's not jinx that. We'll knock on wood. But we'll also see what things look like as quantitative easing begins to likely unwind very slowly before year end. Okay, so I also wanted to quickly hit on one wealth management topic for this quarter. Let's talk about property and casualty insurance. I've noticed after doing annual reviews with my clients that often when I mention this subject, I learned that most of them haven't had this reviewed in the past 5 years. That's auto, homeowners insurance, umbrella coverage, which means they have no idea if they still have the appropriate coverage. And if the premium they're paying is even competitive, there's an easy solution. It's often neglected, but it's simple as follows. Call us, and I have some great contacts in this area who my team can get you in touch with that we highly trust to give you a free, honest checkup and look for ways to hopefully save you money or increase your risk management to the appropriate levels. And I don't make a shiny cent on any of this, but that's okay because most of you already gripe about our investment fees, right? So seriously, let my team know that if you want to review your property and casualty insurance. We'll help connect you to someone that we like and trust, and we'll get your policy info over to our team to make it as easy as possible, and you'd have to do as little work as possible. All right, so that does it for this quarter. I'm David Adams, and please remember that there are more important things in life than worrying about money. Please take the time to spend your time with your loved ones, focus on what's important in life, and let our team know where we can help you. Until next quarter, take care.